Peter Kelkar joins us, Group CEO of Cox and Kings, to talk about the numbers and what was the rationale behind the demerger. Peter, good morning. Thank you for joining us. What is the rationale behind this kind of an demerger, and how do you think growth potential will be unlocked?
You see, the foreign exchange business has reached maturity, and one of our decisions was due to capital allocation. Now, as a financial services company, our division can actually leverage its balance sheet far better than a travel company. Also, the focus of the management in the travel company is to sell travel, not to sell foreign exchange or the related services. And most importantly, in the most recent survey that we have seen, more than 85% of holidaymakers want to pay by installments. So these are the factors that actually made us realize that we were at an inflection point, and it was critical for us to address this and have a separate management team look at the foreign exchange division to see that it could leverage its growth and its true potential. And that is why we decided to demerge it, so that we could focus on our travel business and the new company could focus on the foreign exchange business, which is really, we estimate to be almost a 61,000 crore specialist travel business, travel Forex business,
Okay, so Cox and Kings Financial Services is in process of applying for a license to operate as an NBFC. What's the kind of timeline that you're looking at, and will you look to eventually list the company as well?
See, currently we have just approved of the demerger. We estimate that this should take between 6 and 8 months to actually achieve. And the company will automatically get a listing as it is demerged, because it will just be a reflection of the parent company which is now demerged. So it should get a listing immediately.
And while losses have contracted significantly, what investors want to understand from you is that when will you see a complete turnaround?
So I think that it has been an incredibly strong quarter for us. If you see our EBITDA, it's grown at 31% year on year, and as a PAT we went from a negative to a positive situation. I think that the main business drivers were the growth in India, which has been robust, and we are seeing this robustness, the fact that GST has come into play, that it's a level playing field for Cox and Kings today. We continue to believe that in the past we've achieved almost a 15% CAGR over the last 3 years, and we believe we'll continue to grow at least at that level, otherwise we'd be disappointed. In addition to that, we believe that abroad our real strengths have come through the bed addition in our hotel division. So in one quarter alone, we put on 1,700 beds, and we're expected to put on another 2,000 beds this fiscal, which means that our capacity again over there has nearly gone up by 50% of the existing capacity as of last year. And finally, on the education division, it's extremely robust. It's like an annuity business, and in pound terms, even that grew year on year. So all three areas of our business, we are seeing a very good traction. And we believe that this could be a very significant year for us, particularly given our market leadership position.
So Peter, when will we see margins break into double digits, and what would you say would be the key margin drivers?
Well, you'll already see that our EBITDA margins from last year have significantly improved, because what we did last year was we got rid of all our operations that were substandard, or we were not the #1 player in that particular market segment. So we're expecting our EBITDA margins to remain in the high 40s, and we don't believe that there is pressure on margin. In fact, our margin has actually improved by at least 200 basis points.
Of segmental revenue, education has been a sluggish pocket for you. When do you think that could pick up?
Well, if you see, the international leisure has been sluggish, but a lot of that has been due to the fact that our biggest part of our international leisure group was our UK business, which, as you know, the pound over 2 years has lost nearly 20% in value. So if you look in terms of the future growth of this particular part of our business, our Dubai business and our other areas have picked up the slack. And so we believe that we should see a slightly better performance going forward, but it will still be in single digits for the international leisure business.
Right. So in terms of your future outlook, do you stick to the guidance of 15 to 20% EBITDA growth for the consolidated entity?
So margins, we believe, are not under pressure. So we should be able to maintain them at this year's levels. However, we've guided that, especially on our India business, we should be continuing to see a 15% growth rate going forward. And in our international business, around 1% and a blended basis of around 10% for the group.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.